Welcome to the Commercial Real Estate Deal Room. Today we're looking at something a little different from the last few deals we've covered, and I think that difference is actually one of the more interesting parts about this analysis. We're breaking down a Burger King in Victoria, Texas. Asking price of $2.84 million, 6% cap rate, absolute triple net. About 15 and a half years left on the lease. On the surface, that's a compelling set of numbers. But here's what I want to explore with you today, because this deal has more going on beneath those numbers than most people will take the time to look at. Hi, I'm Mercedes Schaffer, a commercial real estate broker and business broker working with investors nationwide. And I'm the agent who will tell you what most other agents won't. I do a deep dive and highlight the risks as well as show you where the hidden opportunities are. And I don't just evaluate the lease and location because that never tells the whole story. I also assess the brand and the business behind the real estate, because if the business isn't healthy, the real estate investment itself can quickly become vulnerable, and this is the part that most investors overlook. My goal is to help you understand exactly what you're buying before you buy it, so you can make an informed decision and avoid the kinds of mistakes that are difficult and expensive to fix after the fact. Now, let's dive into it. Let's start with the basics, because I always want to ground us in the facts of the deal before we go anywhere else. This is a Burger King in Victoria, Texas, a mid-sized city in South Central Texas, about 115 miles south of San Antonio and about 128 miles south of Houston. The building is approximately 2,854 square feet, built in 2021 and opened in 2022. So this is relatively new construction. It includes a drive-through, which, as I'll touch on later, is not just a nice feature, it's a functional necessity for any QSR operating in today's environment. The asking price is $2.84 million, or about $995 per square foot. The cap rate is exactly 6%, and the net operating income coming in the door today is $170,400 per year, or $14,200 per month. Now, a 6% cap rate on a Burger King in a secondary Texas market is worth pausing on, because it tells us something important. Cap rates in the triple net world reflect risk and quality. For the absolute strongest brands in the best coastal markets, Chick-fil-A in California, McDonald's in Chicago, you're typically looking at a cap rates between 4 and 4.5%. 6% is higher than that, and that gap is intentional. It reflects the market's honest read on the combination of brand, location, and tenant profile here. Not a red flag, but a signal worth understanding. And understanding exactly what you're buying, being compensated for, is what we're going to do today. The lease structure is absolute triple net, which is the gold standard for passive real estate investing. The tenant handles taxes, insurance, and all maintenance. Zero landlord responsibilities. And this is a fee simple deal, meaning you own both the land and the building. That matters for two reasons. You can depreciate the building for tax purposes, and you own the full asset, not just the dirt beneath it. Let me walk you through the lease structure, because structure matters as much as the headline numbers. And this lease has some strong features that I think deserve attention. What we have here is an absolute triple net lease, the cleanest structure available in commercial real estate. Absolute triple net means the tenant, not you, handles everything. Property taxes, insurance, roof, structure, maintenance. As the landlord, your only job is to deposit the check. That's what absolute triple net means. No management burden, no surprise phone calls, no capital expenditure requests. The initial lease term was 20 years, which tells you this tenant made a serious long duration commitment to this site. With approximately 15 and a half years remaining, plus 5 renewal options of 5 years each, the potential visibility on this income stream extends well into the 2060s if the tenant stays and exercises all of those options. And that's a meaningful runway. The rent increases here are 7.5% every 5 years. Now, let's put that in context. The Arby's deal we looked at recently had 1% annual bumps, which is very modest. The Chick-fil-A deals we see often have 10% bumps every 5 years. 7.5 years every 5 years puts this deal right in the middle of that range. It's not dramatic growth, but it's growth. And in an inflationary environment, having rent that steps up every 5 years, even modestly, is meaningfully better than a flat lease. And this is Texas, which is one of the most important words in triple net real estate right now. No state income tax. If you are an investor in California, New York, or New Jersey, the rental income you collect from a Texas triple net property is not subject to state income tax in Texas. That is a quantifiable economic advantage. It's one of the primary reasons high tax states investors specifically seek out Texas triple net assets. For a California investor in a 13.3% state income tax bracket, that differential is real money year over year, compounding over the full life of this lease. The other thing I want to highlight is that Texas as a market is one of the most active in all of triple net real estate right now. Population growth, business migration, strong employment base, these are the macro tailwinds that support long-term real estate value, and they're present here in a meaningful way. Now let's talk about the rent to sales ratio. This is one of the most important metrics in any triple net analysis because the lease is only as strong as the EBITDA the underlying business can generate. The annual rent here is approximately $170,400. Using Burger King's national average unit volume of roughly 1.63 million, the estimated rent to sales ratio comes out to about 10.4%, and that is a real risk factor. At that level, the store has less room for operational pressure before EBITDA starts getting compressed. Rising labor costs, food inflation, softer traffic, or weaker execution can quickly impact profitability when occupancy costs are already consuming a meaningful percentage of sales. Now, this location may outperform the national average given the newer building, drive-through format, and retail positioning. But until the actual store financials are reviewed under NDA, I would view the estimated 10.4% rent to sales ratio as something that deserves very close attention in the underwriting process. And this is where I'll pause for just a moment because I know this is where the analysis can start to feel like a lot. Ratios, EBITDA, sales estimates, it can feel complex when you're trying to evaluate whether a deal actually makes sense for you. And here's what I want you to know. This is exactly the kind of work I do with clients on the back end. We sit down with the numbers, build the model, evaluate the risks, and come out with a clear picture of what you're actually buying. So if you're actively looking to invest, or you're in the middle of a 1031 exchange and need to identify and evaluate a replacement property, reach out to me using the contact information in the description below. I'm happy to walk you through the process. Now, let's look at the brand. This is the section I always look forward to, and it's also the section most investors skip entirely. The brand is not just a name on a sign, it's the engine that drives the cash flow that makes the lease viable. So let's talk honestly about where Burger King is. Here's the most important thing to understand about Burger King right now. This brand is in an active, well-funded turnaround, and the early results are encouraging. Let me give you some context about the competitive landscape first, because I think it helps frame the brand conversation. In the burger category, you have a wide range of trajectories. McDonald's is the global giant, nearly $54 billion in US sales, arguably the most powerful fast food brand on earth, with an operational infrastructure that is essentially impossible to replicate. In-N-Out is the cult brand, lines around the building, customer loyalty, essentially zero advertising, operating in a completely different category in terms of consumer perception. On the opposite end, you have legacy brands that have been losing relevance for years, brands that had strong decades but failed to evolve meaningfully for younger consumers. Burger King sits somewhere in the middle. It's the world's second largest burger chain by location. Over 19,000 restaurants globally with $11.5 billion in annual revenue. That's a real global business with institutional scale, but it also spent several years losing ground. Between 2019 and 2022, same-store sales were flat or declining. Franchisee profitability had eroded. The brand's image was aging, and consumer perception was drifting. In September 2022, the parent company, Restaurant Brands International launched what they called the Reclaim the Flame Plan, a $400 million commitment to advertising, technology upgrades, and a physical remodel program called the Royal Reset. The goal was simple: modernize the brand, improve operations, and restore franchisee profitability. The question was whether it would work. Here's what the data shows so far. U.S. same-store sales grew 7.5% in 2023. They grew another 1.5% in Q4 of 2024, actually outperforming McDonald's in that quarter. In Q3 of 2025, U.S. comparable sales hit 3.2%, the brand's best performance in over a year. Average franchisee profitability per unit, what RBI calls home market franchisee EBITDA, went from $140,000 per store in 2022 to approximately $205,000 per store in 2023 and 2024. And remodeled locations under the Royal Reset program are showing double-digit sales lifts in many cases. By 2025, 58% of the U.S. system is in modern image branding, up from 37% in 2021, with a target of 85 to 90% by 2028. And then this is the part most investors don't evaluate properly, where you can actually see whether the brand's trajectory supports a long-term commitment to this real estate. What I'd highlight for you is this: the turnaround is real, the investment is real, and the early results are real, but it is still a turnaround. Burger King U.S. average unit volume in 2024 was approximately 1.63 million, which is meaningful progress from where it was, but still well below where a brand of this scale would want to be. McDonald's, by comparison, averages closer to 3.5 million per U.S. location. That gap tells you where the opportunity is and where the continued work lies. For a 15-year investment, the relevant question is not where the brand is today, it's where it's headed. And right now, the trajectory is cautiously positive in a way it simply was not 3 years ago. Now let's talk about the tenant, because the name on the sign and the entity signing the lease are two different conversations. The subject property is operated by an experienced multi-unit Burger King franchisee, and it's backed by a full personal guarantee. Now, the offering memorandum is deliberately vague on the specific franchisee's identity, which is fairly common in single-tenant triple net marketing, but what we do know is this guarantee is personal, meaning the individual owner is personally on the hook for the lease, not an LLC or operating entity. That's a more meaningful form of credit support than a corporate guarantee from a holding company with limited assets. And the financials are available under NDA, which creates full transparency for the buyer. Here's what I would want to understand in my due diligence as a buyer's agent. I want to review the operator's balance sheet. How many locations do they operate? What's their overall financial health? And how is this particular location performing relative to their portfolio? From a parent company standpoint, Burger King is owned by Restaurant Brands International, headquartered in Miami. RBI is a publicly traded company on the New York Stock Exchange with $11.5 billion in annual revenue. The parent company's scale and financial stability are real, and the corporate backing adds a layer of reputational and operational support that a smaller franchise system simply can't match. RBI has demonstrated with its Reclaim the Flame investment that it is willing to put significant capital behind its franchisees and its brand, which is a meaningful positive for anyone holding a long-duration Burger King lease. Let's zoom out now and look at the market, because this is where the deal starts to get interesting from an investor standpoint. Victoria, Texas may only have a population of around 65,000, but it functions as an economic hub for a much larger 7-county region with a retail trade area exceeding 200,000 people. That regional draw matters because this property benefits from far more than just the local population. The local economy is supported by 3 major sectors: healthcare, retail, and energy. Healthcare is particularly important here, with 5 hospital campuses and over 720 beds driving stable, recession-resistant employment. The property also sits in Victoria's primary retail corridor, positioning it directly in the path of regional consumer traffic. Now, this is not an Austin-style hyper-growth story, and that's important to understand. Victoria is a stable regional hub with deep economic roots, not a speculative growth market. And for many investors, that stability aligns well with the actual investment thesis here: durable income backed by a real operating economy. And at the state level, Texas continues to benefit from strong economic growth, a business-friendly environment, and no state income tax, all of which continue to attract both businesses and investors. Now let's get specific. Where exactly is this building, and what does the immediate trade area look like? This Burger King sits on North Navarro Street, which is US Highway 77, one of the primary commercial arteries in Victoria. Traffic counts on this corridor exceed 34,000 vehicles per day. And adjacent to this site is Zach Lentz Parkway, which carries about 33,000 plus vehicles daily. That intersection level traffic volume is meaningful for a drive-through concept. Drive-through revenue at QSR brands now accounts for the majority of sales, in some cases 70% or more. Visibility, accessibility, and traffic density are the variables that drive that number. This location checks all three boxes. And here's what I find most compelling about this location, and it's something I want to highlight because this is where the site selection really becomes evident. Surrounding this property, we have Walmart Supercenter, Sam's Club, Lowe's, Target, Kohl's, Academy Sports, Best Buy, Walgreens, Chick-fil-A, McDonald's, Popeyes, Whataburger, Sonic, Taco Bell, Dunkin', McAllister's Deli, Crumble Cookie, and Victoria Mall. This is Victoria's primary powerhouse center. This is where the city shops, eats, and runs errands. If I'm thinking about a replacement tenant scenario, in the unlikely event that this operator ever vacated, this site's position within the dominant retail node of the city, with its drive-through infrastructure on a high-traffic state highway, would make it one of the more re-rentable QSR buildings you'd encounter in a market of this size. Let's talk about the physical asset, because in an absolute triple net, it's easy to think the building doesn't matter, but it does. And this one has some things worth talking about. Built in 2021 and opened in 2022, this is a relatively young asset. At 2,854 square feet with a drive-through configuration, it's in Burger King's modern footprint range. And it's worth noting that this building appears to reflect the newer Burger King aesthetic, the cleaner, more contemporary design language that has emerged from the Reclaim the Flame Remodel initiative. That's relevant because Burger King's Royal Reset program is specifically targeting the modernization of older locations. And a location that was already built to a modern standard is not going to be carrying the same remodel risk or obligation as a 20-year-old building that needs to be updated. Here's something I also think is important to consider more closely, and this is the part that most agents don't get into, where the real story of the deal starts to show up. Burger King's remodel program ranges from a light refresh at around $500,000 to a full scrape and rebuild at $1.8 million or more. Because this building was constructed in 2021, a major remodel is not on the near-term horizon. That mitigates a meaningful amount of risk for the operator. Capital expenditure obligations are one of the factors that strain franchisee economics and, in some cases, lead to operators making decisions about whether to renew. A modern building reduces that pressure. I would also want to understand this building's history since opening. It's been operating roughly 3 years now, long enough to have established a sales trajectory. And since the lease includes financials available under NDA, I would absolutely want to review those numbers as part of my serious due diligence process. Understanding how this location has performed since opening is essential context for evaluating whether the rent structure is sustainable over the long term. All right, let's get to the part of the analysis that I think matters most, because every deal tells a story, and the real question is always whether that story matches your goals. So is this a good deal? My honest answer is yes, for the right investor. And let me be specific about what that means. This deal works well for an investor who values cash flow from day one. And the 6% cap rate delivers that in a way that many triple net deals in today's market simply cannot. It works for an investor who wants Texas, who understands the non-income tax advantage and the long-term fundamentals of the state, and who is comfortable with a secondary market that is stable and established rather than rapidly growing. It works for an investor who has thought carefully about Burger King and believes that the brand will have a successful turnaround, in which case the asset will be materially more valuable in the future. And it works particularly well for a 1031 exchange buyer who needs to identify a replacement property quickly, wants a clean passive structure, and has Texas on their target list for tax efficiency reasons. Where I would apply more caution is in an investor who wants the absolute highest brand quality ceiling, someone who would only be comfortable with the Chick-fil-A or a McDonald's corporate guarantee at any price. Burger King is a fundamentally different risk profile, not necessarily worse in every dimension, but different. And for an investor who needs a large metro market or a coastal location, Victoria, Texas is not that. The retail fundamentals here are strong for the size of market, but the market itself is smaller and more isolated than what some investors require. Here's what I think this deal offers that is underappreciated: a meaningful yield premium over top-tier brands in a tax-favorable state on a new building with strong co-tenancy, backed by a brand that is actively investing in its own improvement. That combination at $2.84 million is a real opportunity for the investor who evaluates it carefully and understands what they're stepping into. So, does a 6% cap rate on a Burger King in Victoria make sense to you? I like to hear how you're thinking about it. Drop your thoughts in the comments and tell me whether you think the Reclaim the Flame turnaround will be successful. I love reading how different investors are approaching these questions. Now that we've walked through the full picture on this deal, the brand, the lease, the market, and the numbers, the real question is what the right strategy looks like for you. Because every triple net investment is only as good as the fit between the deal and the investor. And what we've covered today is the kind of high-level overview that helps you decide whether to take a closer look. When I'm working with a buyer on something like this, we go significantly deeper. We pull the actual financials under NDA. We review the franchise agreement. We evaluate how the operator's full portfolio is performing, not just this location. We model out multiple scenarios, base case and stress case. So there are no surprises and you understand exactly what you own before you close, because there's no such thing as a risk-free deal. The difference is whether you understand the risk before you buy or discover it afterwards. What this investment offers, done right, is a long-duration passive income stream anchored in a well-located Texas asset in a tax-efficient state backed by a brand that is actively working to improve its own performance. When those factors align with your goals, this becomes a powerful vehicle for building patient, durable wealth. When they don't align, the best decision is a confident pass. And knowing which situation you're in is exactly what thorough due diligence is for. If you want to keep seeing this kind of analysis, deals broken down honestly, risks identified clearly, and the business behind the real estate taken seriously, make sure you subscribe so you don't miss the next one. And if you're actively looking right now, whether that's a first triple net acquisition or a 1031 exchange, and you want an agent who brings you both commercial real estate expertise and business brokerage perspective to the table, I work with a focused group of clients and guide them through the entire process from identification through closing. The heavy lifting is on me. The clear picture of what you're actually buying is what you get. My contact information is in the description below. And if you're on the sell side and you own an investment property and want it positioned in front of a targeted audience of serious investors, I work with an active network of qualified buyers, and every deal I represent gets featured on this channel with the kind of detailed, credible presentation you've been watching today. Thanks for watching. I'm Mercedes Schaffer. This is the Commercial Real Estate Deal Room. I'll see you in the next deal.